Hi everyone, a very good morning. How are all of you doing today? Uh, just a quick question. Am I audible? Am I visible? Can I get some hellos? I see a lot of you on the call already. Thank you so much for joining. Hi Praveen, Pradipta. I know you guys were the first ones to join. Hi Kiran, Chandan, Mohit, Senthil, Chetan. Wow, there's so many of you here. Then I have Apurva and Rathod biology classes. Okay, Venkat, Deepak, Mandar. Hi Satish. Hello Subhashish. Meher Baba, Vikas, Yamini, Praveen. Good morning, all of you. Hi Athar, Anup, and Mr. Mahendra, Ravi, Devendra, Rohit Patil, Ashwin, Devraj. Hello Ignatius, welcome back. I know you've been attending my sessions in the past. Thank you so much for coming back. Hi, Shailendra. Hello, Prajapati. Okay, Shruti, Priyabhatra, Amit, Aniket, Nihar. Hi, good morning, everyone. We're just going to wait for another 1 or 2 minutes for more people to join in, and then we're going to start this wonderful masterclass that I'm truly, truly excited about. Just a quick question. Am I visible? Am I audible? Can someone just let me know? If someone could just put it on the chat that I'm visible, I'm audible, please. Yes. Can all of you hear me? Can you see me? Yes, visible, audible. Thank you, Kirtish. Thank you everyone for telling me that. Thank you so much. Hello Narsimhan sir, welcome back. Thank you so much for coming back every weekend. I know you are my most regular audience, so thank you so much for joining back. So how are all of you doing today? I would need just another minute, and then we're going to start the session. Oh my God, someone's asking me for my age. Why would you want to know that? Okay, I'm just going to start in another minute, guys. Just give me another minute, and you guys tell me how are all of you doing today? Yes. Honestly, I'm honestly genuinely very excited to do this particular session. I do believe that, this is going to be a wonderful learning experience for all of you. Uh, Thank you for all the comments, compliments, all of that. Thank you, guys. Thank you, Arun. Okay, let's start. And I know a lot of you are getting very restless to start the session, so I'm going to do just that for all of you. So let me quickly introduce myself for those of you who are new to this particular session, and this is your first session that you're attending. My name is Namrata, and I've been associated with Grow for a really long time. We've been doing a lot of programs, a lot of a lot of content, a lot of videos that we do for Grow, where we try to teach different concepts to all of you, because all of you are with Grow, and all of you are all of you like Grow, I'm guessing. So we try to come up with some interesting conversations for all of you, where we try to pick a topic and we explain that in detail. So we started these master classes in the month of July last year, or July last year. So it's been 7-8 months, and we've been doing this like every weekend, every Sunday, in Hindi and in English. And we've covered a host of topics. So for all of you who are attending this for the first time, we've covered topics like fundamental analysis, how to analyze stocks. We've discussed so many topics on mutual funds and so many topics on stocks. You can just go to the YouTube Grow and just type Grow Masterclass. You'll get a list of all the sessions. Okay. So today we are going to have a very interesting conversation. Okay. Now, just a few disclaimers, guys. This session is going to be in English, and I'm going to do the same thing at 12:30 in Hindi. So for those of you who want to listen to me in Hindi, can join back at 12:30. Okay. मोहित, मैंने अभी आपको बोला है कि ये सेम सेशन मैं हिंदी में 12:30 बजे करूंगी. तो अगर आपको हिंदी में सुनना है तो आप 12:30 बजे लॉग इन कर सकते हैं. ठीक है. So I don't want any conversations around language, because we are trying to make sure that we are covering both the languages for all of you. So today we're going to talk about how to create a financial plan. And I do believe that it is such an interesting topic. I don't have a presentation for all of you today, because today we're going to do a simulation, and I'm going to show you how to a large extent what is it that you can do to understand your life journey. we have done so many sessions for all of you in the last 8 months where we've explained multiple concepts and where we've explained multiple things that you should, as an investor, keep in mind. But today, I'm going to put all that into execution and show you how it is done. Okay, so I'm going to show you that if you were to apply those simple things that I've taught you, how your life journey would look like, and will you really be able to achieve all your goals that you want to achieve. Okay, so today is all about execution. And like I said, I don't have a presentation today. Today is going to be a simulation day. So what you guys can do is I'm also going to show you how to plug in the formulas and stuff. It's super simple and you guys can do it on your own. And you can watch my video multiple times to understand how you can plug in those formulas and create that particular sheet for yourself. Okay. Now, I do believe that in the last 2 years, so much has happened, right? There's been like so many ups and downs in our lives, personally, professionally, financially, emotionally. I'm sure all of us have gone through a huge roller coaster ride in the last 2 years, and I do believe that a lot of us think, are we really doing it right with our money? I'm sure you guys have this question. I've applied all the logic that people have told me, that I've learned, and is it still right? Am I doing the right thing? And many of us are questioning our discussion or our decision about equity right now, right? I mean, last year equity was great, now markets are volatile again. What is happening, and is equity going to do well, not going to do well? So what is happening with my portfolio, right? So I'm sure a lot of us have these questions in our mind, and we've been attending these classes to understand different aspects. I'm sure all of you hopefully have learned certain things from my classes and have applied it in your investment journey. But I do believe that everyone's journey is different. Everyone's goals are different, dreams are different, aspirations are different, right? Everyone has different things that they want to achieve in their life from an investment money point of view. Yes. So in this session, we're going to put all those pieces together from a money point of view, and I'm going to give you a holistic view of your life journey. Yes. And I'm super excited to do this because I know that it's going to be an eye-opening session for all of you. So, if you just sit here for the next 1 hour, you will see that how you can apply the simple things that I've taught you, and it's going to make such a big difference to your investment journey. Okay, so let me start off by first sharing my screen and showing that particular template that I have created for all of you. Just give me 1 minute. Yeah, just a minute, guys. Yeah. Okay. So I'm sure all of you can see this template on your screen. Yes, I've tried to make it in big font so that it's visible to all of you, right? So now what we're going to do is I'm going to show you what is it that you can do. It has different steps. So this particular sheet is going to have different steps that I want all of you to follow very clearly. Okay. So first, what are we going to do? We're going to start off by plugging in some simple details like your age, your retirement age, monthly income, monthly expenses, right? So, what should I take as the age of this average group? Generally, I do believe that when it comes to the Groww sessions, we have a lot of young audience, right? We have audience which is not very old, but we also have people who are not in their 20s, but probably 30s, 40s, and we have some very senior people as well who join my sessions. So, what I'm going to do is I'm going to take the age as 31. So let's just say that this individual for whom I'm doing this plan is 31 years of age. Okay. And when you do this for yourself, obviously you plug in your numbers, and let's assume that the retirement age is going to be, say, 56. Now, why am I doing this? Because, like I said, that for a lot of us, we want to retire early, right? I mean, we want to be financially independent at a young age. So I don't know if you guys have heard my session on 7 habits and on basics of mutual funds, you would have realized that I've showed you the retirement calculator, where I've always said that, for a lot of times, for a lot of us, we believe that retirement is something that we do, that, we are working till 70, 80, and that's when we're going to retire. The meaning of retirement is the day you are financially independent. Okay. So the day you're financially independent, you can call yourself retired. And I do think that, about 55, 56 is a good enough time. Shifali, if the Excel is not clear to you, then I think you have to change your HD settings on YouTube. Okay, because it is very clear to me when I'm doing it I can see the screen, and I know that it is quite clear. So For others, if it is not clear, please let me know. But for whoever it is not clear, all you have to do is change your HD settings on YouTube. Okay. So you put in your retirement age. Then what we're going to do is put in a monthly income, right? So how much are you earning every month? And let me just take an average of say 1,20,000. Yeah. So let's just assume that for a lot of us, we are, earning say about 1,20,000. See, I'm just taking these as tentative numbers. Obviously, you're going to put in your numbers. Yes. Now, monthly expenses. So, what are going to be your monthly expenses? What you have to do is whatever you are saving every month. Yeah. Whatever amount you're saving, just remove that from monthly income and put the remaining as expenses. So let's just assume for this individual, let's call this individual Ajay. Okay, let's just name him Ajay. We'll put monthly expenses as 1 lakh. Okay. So which means that this particular individual is earning 1,20,000 a month and he's spending 1 lakh, which means he's effectively saving 20,000 rupees every month. Okay. So this is how we're going to start this journey, where this particular individual is going to start off by saving 20,000 rupees every month. Okay. Now, after we've done this very simple activity of putting in our, basic details, I want you guys to tell me, because now we're going to move on to the goal section. Yes. So we're going to put in our financial goals. I have put in a list of 5 financial goals. What are some of the financial goals that you guys have? Can you give me an answer? So give me an answer. What are some of the financial goals that you guys have? Can I get some answers? So what are some of the financial goals that you guys have? Remember, in our sessions we've discussed that all of us need to have financial goals, and that's the very first step of your investment planning, because if you don't have financial goals, your investments are not going to have a direction in terms of where you see your money, right? I do believe that having a financial goals is a very, 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 very critical step, because it is going to guide us in terms of how our investments should progress further. Yes, so which is why it is very important that we make a list of our financial goals. And how we're going to do that is through this sheet. So first you're going to make a list in terms of what all financial goals that you want for yourself. For example, I have put retirement, then I've put children's higher education. For those of you who have kids, this becomes, a goal. Then children's marriage becomes a goal, buying a house and going on a vacation. Like some of you are saying, business. A lot of you are saying business. Some of you are saying medical expenses. Some of you are saying buying a house, retirement corpus, house, children's education, and so on. Great. Yes. So you can make a list of all your financial goals in the next step. Yes. Now, Narendra saying, I want to earn 5 crores in the next 42 years. Narendra, that may not be a very defined, of course, but for what do you need that 5 crores is what I would want you to put here. And trust me, it is very important to put financial goals, because there are a lot of times when we are doing this activity where we are investing a lot of money, but so many times we are not able to achieve some of our goals. My point is, what is the point of saving so much if we are not able to achieve those dreams and aspirations or those goals that we want to achieve for ourselves, right? So I do believe that having a list of financial goals and making sure that you achieve those financial goals through your investments is an important activity, right? And this is what I'm going to show you, that if you have your financial goals, how you can actually achieve those financial goals through your investments that we are going to learn about. Okay. So it is not just about saving money, guys. It is also about making sure that you save money for your financial goals and you achieve those financial goals. Okay. That is very, very important. So I've taken a list of these 5 goals. You guys can take whatever goals you want and make a list. Then you have to put how much money you would need for that specific financial goal right now. Okay. So which means at this point in time, how much a children's higher education would cost. You just have to put that number. So I'm assuming it to be, say, 12 lakhs again. And this we are putting for higher education. Okay. So what we are doing is we are saying that for higher education, how much money you're going to need right now. So if someone was to go for an engineering degree or something like that, what is the cost of that? That we're going to put here. Then what you're going to do is for marriage, how much money you would need, and say, let me assume, say, about 15 lakhs. That's currently. So today, how much are you spending on a marriage? And the numbers could change, guys. You could decide, but I'm just putting numbers from my perspective. Okay. Next, for a house. So if you want to buy a house for yourself, then how much would it cost? And let me just take, say, about 80 lakhs. Okay, let's just assume that 80 lakhs is the approximate cost of the house that we're going to assume. And next, let's take vacation. Okay, so when we say vacation, then let's just say you're going to spend say about 2 lakhs. Okay, so these are the numbers that I have taken where I'm saying that this is the amount that if I were to if I were to achieve these goals right now, what would be the cost of these goals, right? So higher education, if my son or daughter was to go for higher education today, it would cost 12 lakhs. If I was to get them married right now, about 15 lakhs, house 80 lakhs, vacation 2 lakhs. Okay. Now here you have to write number of years to achieve that goal. So for example, retirement is going to be 25 years. Why 25 years? Because retirement age we are taking is 56 and the current age is 31. So it's already plugged in, right? See so this number minus this number is going to give me number of goal years to the goal. For children's higher education, let's say about 18. So we are saying that this individual who is 31 years old, he has, his probably son or daughter is just about born. So then we can safely assume 18 as the child's higher education. And then for marriage, let's say about, say, 20 years. Okay. And for house, say you want to buy a house in the next, say, 8 years. Okay. Or you want to build your house in the next 8 years, and say vacation 5 years. Okay. Again, like I said, I'm just putting these numbers to explain it, and you're going to put your numbers to do the calculation for yourself. Yes. Now, what I'm going to do is I'm going to put the inflation number. I'm sure all of us understand what is inflation. Inflation is basically increase in the price of goods and services. And we have to assume inflation because every year the cost is increasing, right? Every year the price of a particular item is increasing, and inflation is something that has to be considered while we are doing this calculation. Now, understand one thing, that inflation is going to be different for each of these goals. So, for example, for retirement, I think we can safely assume, say, about 6%. Okay. We can say that for retirement, the inflation is going to be 6%, which means my expenses currently are going to increase by 6% every year. Now, one question, why has this, how is this calculated, the retirement number? So, retirement number is a very simple activity. Your monthly expenses currently into 12. So, which means currently I need about 12 lakhs to manage my expenses annually. So, this is my annual number. This particular number that you see is my annual expenses. So, this is the amount that I need to manage my retirement. And I've taken 6% as inflation for this. Now, here, what I have done is a very interesting thing. I've calculated the future value. So, what is the future value? So, basically, if currently if I was to retire today, I would need 12 lakhs to manage my expenses. That is what this corpus number means. So, if I was to retire today, I would need 12 lakhs. This means that if I'm going to retire after 25 years, what would be my annual expenses? And that is about 41 lakhs 20,000. Now, I'll show you how this is done. So, all you have to do is future value. Okay, and then first you put the rate. So rate is the inflation number. Then input is the number of periods, which is your number of years. Then PMT is 0, and your present value is this. And then you put a 1. That's the type. And you will get this number. Now, why are these two numbers different? Because here I have taken 80%. So here, what am I assuming? I'm assuming that when you retire, your expenses won't be as much as they are today. They'll probably be about 80% of the current expenses. So what I'm saying is that at the time of your retirement, if you were to go with the same number, so if you were to go with 12 lakhs annually today, would become 51 lakhs at the time of retirement annually. But I'm only taking 80% of that. As you can see here, 80% of that, because after retirement, you may not need all the money that you're spending right now. Your expenses would reduce after retirement. So that's why you take 80%. Okay. So this is how your retirement is calculated. Then we take inflation for child's higher education, which I can take as 8. Now, higher education inflation is slightly higher. I'm sure all of you would agree to that. So higher education is on the higher side, and that is why you can take about 8%. Now, for marriage, you can take, say, about 7%. For house, you can take 6%, and for your vacation, you can take about 4%. Okay. Now, why vacation I've taken less? Because come to look in the last 10 years also, it's not like your flight costs or your hotel costs have increased drastically. They're not, right? They've increased very slightly. So, which is why we take slightly lower inflation in terms of vacation. Now, one thing that you have to understand, look at the house. I've taken house as 80 lakhs, but here, what is the corpus required is only 25 lakhs, because when we are buying a house, we are not going to buy the house by paying the whole amount. We're going to take a loan. So I've only taken the down payment amount as the required corpus, which is about 20%. So as you can see, this number is only 20%, okay, of the future value of 80 lakhs. So ideally speaking, if I was to fund everything on my own, I would need about 1 crore 27 lakhs. So after 8 years, the house which is worth 80 lakhs right now will actually be worth 1.27 crores. But I'm only taking 20% of that because I'm only going to save money for the down payment, but remaining I'm going to take as a loan. I hope that is clear, right? So for your house, you take 20%, which is more than enough. And for everything else, it is a standard. I mean, yeah, at this point in time, we are not saying that we'll take a loan for education and all of that. So is it clear so far? So what we have done is we have put in the financial goals where we have said that when you're planning for retirement, children's education, marriage, house, vacation, and I've put a number of years to achieve that goal, and what is the inflation to calculate what would be the value of the goal at the time that I want to achieve it. Okay, and then you would get so use the future value formula which I just showed you, and you'll be able to get the number. But for retirement, you can take 80% because what your expenses are today, it may not be the same after retirement, it will be slightly lesser. So you could take about 80% of the current expenses. And for house, you can just take the down payment amount, which is 20%. You don't have to take full 100% because nobody really buys a house by paying the whole amount, right? You take up a loan, a home loan. So which is why you could do this. Now, I do believe that home loan is a good loan to have, by the way. Okay. There are certain good loans, there are certain bad loans. So, good loans would be like your home loan, your education loan. The not so good loans would be your, car loan, personal loans, credit cards. These are not good because the interest rate is on the higher side. But for, say, a house or for education, the interest rates are on the lower side, and we also get tax exemptions. So, these are good loans to have. So, it is okay to take a loan for these goals that you have. Okay. So for house, we are only taking the down payment amount, which is 20%. Clear? So now moving on. Now what we are going to do is we are going to put what are your current assets. So how much do you already own? Now I want to tell you the difference between personal assets and financial assets. Okay, please understand that. Your personal assets are those assets which you are not going to sell to achieve a particular goal. So for example, if you have certain jewelry with you, you do not add that in the assets because jewelry is not something you're going to sell to achieve your goal. Agree? So, which is why when we are looking at assets, we are only going to put our financial assets, which means only those assets or those investments that I'm going to use to achieve my financial goals. So, for example, fixed deposits or any of our fixed income products. Then you have your equities, right? So it could be stocks, mutual funds, all of that. Hi Ajay, good to see you. So yeah, so we're doing this example for someone called Mr. Ajay, who's a very hypothetical person that we've taken. Okay, and then we've taken gold because we do make investments in gold, maybe in the online digital format. But do not take jewelry here. So whatever is the value of the jewelry that you own, that you should not be taking here because that is your personal asset. That is not a financial asset. We do believe that you should not use jewelry because jewelry is an emotional asset. So a lot of times we never sell our jewelry to achieve a financial goal. So say if your child is going for his or her higher education, are you going to sell your jewelry to fund it? You're not, right? So that is why you do not take your jewelry here in this calculation. Then for all of you who are working, if you have businesses, you have your PFs, right? You have your provident fund accounts. So whatever is your provident fund amount, I want you guys to put that here because provident fund is generally a big chunk that all of us have, and that should be a part of the portfolio. Whatever is the current provident fund amount, not your futuristic value. Then bonds and fixed income would be probably like your, like your debt funds that you've invested in. Then insurance. So a lot of us have, life insurance, but say money back policies, endowment policies, that we're going to get some money back after a particular number of years, right? So insurance is also something that you can put here. Real estate, if you stay in your house, that house in which you are living, that you should not include in the value of assets because are you going to sell your house to fund any of your goals? You're not, right? See, what I'm trying to show you is a journey in terms of your investments, right? So based on all your goals, based on all your investments, are you doing it right currently? Are you doing a good job with your investments, right? And we are going to do a realistic calculation, correct? If you put real estate, we can say, we feel very happy that I have a house which is worth 2 crores. A lot of people say that my net worth is so much because I have a house which is worth 2 crores. But tell me something, If you have a house for 2 crores, are you going to sell it to achieve any of your financial goals? You're not, right? For your vacation, for your retirement, are you going to sell that house? Then where are you going to live, right? So, which is why you do not consider the house in which you're living as a financial asset. That will be a personal asset. And then your savings bank account, whatever you have. So, I'm going to put some hypothetical numbers for these. So, for example, for fixed deposits, let me say put about 4 lakhs. Okay. For equity and mutual funds, let me put 8 lakhs. Basically, this is a portfolio of Mr. Ajay that I'm designing, right? Whoever, this particular hypothetical person that we have. For gold, let's just assume 50,000. Because this is financial assets, guys. This is not jewelry. Yes. So for PF, let's take 4 lakhs. Bonds, let's just say this person has 0 in bonds. Insurance, let's take 6 lakhs. So basically, your money back policy is going to give you, say, about 6 lakhs. Let's take real estate as 0, and savings account, say you have 20,000. Okay, so basically, these are your assets that you currently own. Is that fine? And then we see something as the weightage. Now, what is this weightage? So the weightage tells you that in the whole portfolio, so all your assets put together, what is the weightage of a particular asset? So basically, in my total portfolio, financial assets portfolio, which is worth, say, 22 lakhs, my FDs contribute 4 lakhs, which is 17.6%. So my FD is contributing about 18% to this particular portfolio. So which means in my total portfolio, my FD is contributing 18%. In my total portfolio, equities are contributing 35%. In my total portfolio, gold is contributing 2.2%, PF is contributing 17.6%, and so on. So what is the weightage? What is the percentage that a particular asset class is contributing to the entire portfolio? Yes. And how do you calculate this? It's very simple. So whatever is this, so the value or how much you've invested, say, in a fixed deposit divided by the total amount is going to give you the weightage. Very simple calculation, right? Now we're going to plug in the returns. And now returns are going to be interesting. We are going to be a little conservative when we are taking returns into account, because come to look at it, when we are doing a calculation, we should do it from a worst case scenario point of view, that, you know, what is the least probable or the the most probable thing that I would get, right? We are not going to expect very high returns when we are doing this calculation. So let's look at the returns for fixed deposit. We can say about 6%. Now I know a lot of you are going to tell me FD is giving only about 5.5%, but then we take the average returns, right? An average FD has given, say, about 7% in the past, so we take about 7%. For equities, I would say take about 12. Don't take too much. Don't take very high returns. Just take about 12%. Okay. Now, like I said, it is good to be conservative. Now, a lot of you are probably into trading and, who are very aggressive investors in terms of equity. I'm saying just do this, just take a 12%, and I will show you the result, and I'll show you how even this 12%, if you've considered as the conservative thing, how this could actually help you in achieving your financial goals. So being conservative in terms of your expectation is not bad. If you get more than this, great. But let's be conservative in terms of our expectation. For gold, I think we can safely assume, say, about 8%. Yes. For Provident Fund, let's assume 7.5%. For bonds and fixed income, anyways, we don't have it, but let me just put 8% in case you want to change it. Insurance, about 5%. And for savings account, about 4%. Okay. These are the returns that you can expect to some extent, right? So now, why are we taking these returns? So like I had said, these returns are again, hypothetical. I would say just the average numbers that we have taken. For equity, I've taken conservative numbers, but these are pretty much like, the average numbers that you can expect from your investments that you have made. Now, what is this returns weightage? So a lot of you must be wondering, what is returns weightage? So please understand, I've heard a lot of people tell me that I hold my equity is giving me, say, 20% return. And, that is why my investments are doing great. But what you have to understand is that your return is not just an outcome of equity as an investment. Your total returns is an outcome of your whole portfolio, correct? So returns weightage is actually telling us what is the weightage in terms of returns of that particular asset class in your total return. So your portfolio return in this case, for example, is 8.32%. Okay. So what I'm saying is in this 8.32%, fixed deposit is contributing 1.23%. Equity is contributing 4.23%. Gold 0.18%. So these are the returns weightage in the total portfolio. So if my total portfolio return is 8.32, how much I've got from each of these individual asset classes. And how do you calculate this? Very simple. This returns into this weightage is going to give you your returns weightage for that particular asset class. So just multiply this returns percentage into the weightage percentage of that particular asset class. Okay, and then you're going to just total it up here. So when you just sum it up here, you're going to get it, right? So this is basically this into this, and you're going to get your answer. And this is a sum of all of this. Yeah, that is how you calculate your returns weightage. Okay, so now this is our base. Now this is how I have created my base. So what all have I done in this? First, I have put in my current details, then I have put in my financial goals, and then I have made a list of all my investments. Now, once our base is made, I am going to show you the final result. Okay, and the final result is going to be the defining moment for all of us. The final result is going to tell us if we will be able to achieve all our goals based on all the information that I have provided. This is all my input. I have to see the output now. This is all my input. Based on all the input that I have provided, my goals, my investments, my income, my expenses, based on all of that, will I be able to achieve all my goals that I have, and will I have enough corpus to manage my retirement? Okay, so I'm going to now take you to the retirement to the final product sheet. Okay, so let's look at this. So I have created this for all of you. Now in this, certain things are going to be added, which I will show you. Now, what are some of the assumptions? The assumption is that I'm annually going to increase my savings by 5%. So every year, my savings are going to increase by 5%. Now, what am I going to do here? First, what I'm going to do is my withdrawal. So, for example, in this financial goal, where I've said my vacation is going to come after 5 years, and this is the amount that I'm going to need. So, all you have to do is here, plug in your vacation amount. Okay. Then my house after 8 years, and this is the amount that I'm going to need. So in 8, I'm going to put in my house amount. Okay. Next is so next is my children's higher education is going to come after 18 years, and this is the amount I would need. So what you're going to do is 18, and you are going to plug in the number, which is this. Then I'm going to need my marriage, children's marriage after 20 years, and this is the amount. So all you're going to do is go to 20, and you're going to plug in the marriage number, which is this. And then we're going to plug in the last number, which is retirement. Now here, 25 years, after 25 years, you're going to retire. So here you're going to plug in your retirement number, which is going to be this. Is that okay? So I hope all of you have understood what I'm trying to show you in this particular sheet. So now I'm going to quickly show you how this is done. Now here you take your portfolio returns, which is going to come from here. So just, all you have to do is plug in this. So this is equal to the portfolio return. Okay, and 5% here. Now I'm going to show you how this is done. So far so clear? All of you have understood. So what you can do is come back to this video and see how it is done, because I'm going to show you the formula to make this. Okay, so look at this. What is yearly savings? Yes, so yearly savings is whatever you're saving, right? This is monthly saving, 20,000. So this basically 1,20,000 minus 10,000 minus 1 lakh is 20,000. Multiply that into 12. This is your yearly saving in the first year, in the beginning, right? And after that, we are just going to increase this saving amount by 5% every year, correct? So how is that going to be? So all you have to do is, take the previous year, this into 1 plus the 5%. And of course, we're going to freeze this cell. And then you will get, and you just have to drag it down till 25. So once you drag it down, you're going to get all your yearly savings. So these are going to be your yearly savings. So what I'm saying is every year, starting from this year till this individual turns 56, which is in the next 25 years, These are going to be the annual savings of this person. These are going to be the withdrawals at different times, right? So this is for, say, vacation. This is for a particular another financial goal. Say this is 18 years education, 20 years marriage, and so on, right? So these are the withdrawals which are going to come at different lifetimes. Now we're going to see how do you calculate the net worth of this individual, correct? So we are going to start with this, whatever is the total final net worth. So this number is your starting point, okay? So you're going to start by taking the asset. So whatever you have currently is going to be your starting point, and then you're going to do a calculation. Now from your net worth, so how you're going to calculate this is from your current net worth, you are going to add the savings and remove the withdrawals. So it is going to be, and you obviously multiply it with the returns that your portfolio is generating. So what it means is, first what you're going to do, this plus your yearly savings minus if there's any withdrawal in that year into 1 plus the portfolio returns, and we're going to freeze this cell. Okay. And this, once you drag it down, you're going to get your numbers. Till this particular age, you're going to drag it down. Is that okay? All of you understood this? So basically, why do you calculate net worth? So this is basically, how do you calculate net worth? So whatever is my current net worth, all my assets, in the next year, I'm going to add my savings to it, but I'm going to remove my withdrawal. So if there's any withdrawal, so if I have taken out money for a particular goal, that comes here is going to be removed. And then that particular portfolio is giving you returns, right? Which is say 8.32%. So you're going to include the returns. So you're going to multiply that with the returns to get your final net worth. So these are your goals. These are your annual savings. This is your net worth in every year. So every year you have to see your net worth. Now, as you can see, this is your net worth in the 7th year, but you're going to remove your withdrawal because you're going to take out 25 lakhs from this. So then your net worth will reduce and then it will start increasing again. So as you can see here, your net worth is say 1.56 crores, but you're going to remove about 50 lakhs from it for your child's higher education, and it's going to go down to 1.23, correct? So similarly, that is what is going to happen. I hope everyone has understood so far, and there is no confusion at this point in time. Like I said, you may want to watch this video one more time to just see how I was doing that calculation. But now comes the more interesting part, okay? So now, what I'm trying to say is that as long as these numbers are positive, as long as your net worth is positive, that means you have that much cash with you, that much assets with you, correct? The moment this becomes negative, it means your savings are over. Yes? So let's move on and see. So far it's all positive, right? Which means I'm able to achieve all my goals. And here comes my retirement. Yes? Now, here, how do you calculate? So this is basically my annual expenses. So basically what I'm saying is at this point, I have retired. After 25 years, now this individual has retired. Now it is only going to be withdrawal phase, which means now you're just going to withdraw money annually from your particular portfolio or corpus that you have. Yes, so this is the final corpus for my retirement after achieving all my financial goals, education, vacation, house, all of that. Once I've achieved all these financial goals, as you can see, for retirement, I have this particular individual has about 1.9 crores. And now let's see this 1.9 crores, to what extent it will suffice. Now, first look at this. This is basically your annual expenses, right? Your annual expenses are going to grow by inflation every year. So I've assumed the inflation to be post-retirement inflation to be about 5%, okay? And that is what we are going to use here. So basically your previous year's expenses multiplied by, so it's nothing but this into 1 plus the inflation number, which is this, and we're going to freeze this particular cell. And this, once you drag it down, you'll be able to get the expenses for all these. Now, I have assumed that the retirement for this individual is going to be for 30 years, okay? So which means if this person is retiring at 56, I'm assuming he's going to live till 86, or I'm assuming that he wants to create his portfolio till 86. Clear? So we've done this activity in terms of identifying the annual expenses of this particular individual. So far, so good, I hope. It might get a little technical, guys, but then you have to understand that you have to go through this video one more time then only you will be able to get complete clarity in terms of the portfolio. Now, this is the last thing where here what I'm showing you is the net worth of this particular individual after removing the withdrawals. And obviously, we are going to invest our retirement corpus into a particular product or a portfolio where I'm assuming the return to be about 7.5%. So I'm saying post-retirement returns, my portfolio is going to give me about 7.5%. Clear? So then how do I do this calculation? So it is very simple. This particular number, which is your total net worth, minus the amount that you need, right? Minus this particular number into the total returns is going to give me this number. So it's basically this minus this into 1 plus the post-retirement returns, which is this, and I'm going to freeze this cell. Okay, and then you drag it down and you're going to get. So now the final, let's understand once we plugged in all the formulas, let's see if this is working. And I've created another sheet where what I'm going to do is I'm just going to put in the number. So for in the sheet that I have assumed in the scenario, the net worth of this individual is 1.9 crores, which is the retirement corpus, and number of years to retirement. So what this means is for how many years will this corpus help me survive? As you can see, 4 years after retirement, this is becoming negative, which means if I were to follow this particular strategy that I'm showing you, after 4 years, my portfolio is going to be in negative, which means I'm not going to have money left out for my retirement. Okay, because now it is all negative. If you see it in brackets, it means it is negative, which means with this particular scenario that I'm in, with my goals, with my investments, I will only be able to survive financially for 4 years after my retirement. Okay, and I'm going to put that 4 here, just for all of you to understand. Clear? I hope all of you have understood this. Okay. So now what I'm going to do is, all of you, I'm sure, are worried. All of you are wondering that, oh my God, so if my retirement corpus is going to finish in 4 years, what am I going to do for the rest of my life? How am I going to manage my retirement, right? And that's true. So for this individual, once you do this activity, you will get a particular figure for yourself, and your cells also will become negative post-retirement. And that is where you're going to face the challenge, right? So now I'm going to show you a different scenario. So based on all the discussions we've done in our past sessions, I'm going to show you scenarios to show you that if you make certain changes to your portfolio, how it will impact your post-retirement corpus. Okay. So first, what we're going to do is we are going to do the very first scenario, where the first scenario, what I'm going to do is I'm just going to increase the savings from 20,000 to 30,000. So do you guys remember this? Where we said that the savings is only going to be 20,000, right? Which means the income is 1,20,000, the expenses are 1 lakh. Now let's make the expenses at 90,000. So let's say that this individual has reduced his expenses by 10,000 rupees, which means the savings have gone up by 10,000. So if you just make that one change here, everything else in the sheet is going to change. Okay. So everything is going to change because here your yearly savings have gone up now. Before it was 2.4 lakhs, now it has become 3.6 lakhs, and accordingly the whole sheet is going to change. Now, as you can see, your retirement corpus has become 3.5 crores from 1.9 crores, and now your corpus is going to become negative after 10 years. So which means for 10 years, you will be able to manage your retirement if you were to just increase your savings from 20,000 rupees to 30,000 rupees. Okay. So it is going to be 3.5 crores as your corpus and 10 years. So I'm just going to put that number here, 3.5 crores and 10 years. And this is 4 years, right? So this is scenario 1, where I have increased savings to 30K. Yeah. I hope this is visible to all of you. And I hope you have understood what I'm trying to show you. Okay, is this fine? Now let's move on to the next scenario. So this is scenario 1, where we are saying that just slightly increase your savings. That's it. Don't do much. Just starting point, instead of 20,000, make it 30,000. Look at the difference. You've already managed to increase your retirement corpus by 6 years, which means your retirement corpus will stay positive for the for 6 years, for 6 more years compared to the original scenario where we were just saving 20,000 rupees. Okay. Now, the next scenario that I'm going to show you, so basically these are the workarounds, right? Because if we make these small changes in our portfolio, look at the kind of impact that it can have in your total savings, okay? Because a lot of us have very different notions about our, about our income and about our investments. And I'm just showing you how those small changes is going to make such a big difference. The next scenario is the yearly savings. So here we are saving only 5% every year. So we are saying that, okay, so if I'm starting with say 20,000 rupees per month, which is 2.4 lakhs, or now I've made it 3.6 lakhs, and if I increase that by 5%, right? Let's change that 5% to 7.5%. So instead of increasing your investments every year by 5%, just increase it by 7.5%, not even 10%. Look at the kind of difference that you're going to see. So here again, your retirement corpus from 3.6 crores, it has become 5.14 crores. And now you will be able to manage your retirement for 16 years, instead of the 10 years that we saw in the previous scenario. Understood? So here now your corpus is becoming negative after 16 years. So till 16 years, you will be able to manage your retirement if you were to just increase your savings from 5% to 7.5%. So let me put that number here. So 5.14 and 16. So it is 5.14 crores and 16 years. And here, this is scenario 2, where I have increased annual savings to 7.5%. Clear? So this was another workaround that can really make a big impact on your portfolio. So just by making those small changes, so we discussed this, that you have to start with at least 20% of your income as your savings. Increase it annually, because if you increase your savings annually because of compounding, it'll have a huge impact on your portfolio. The next workaround is I'm going to increase my equity allocation. So a lot of us, we tend to be very conservative, and we say, let me put a little less in equity, but come to look at it, most of my goals are long term, right? Apart from vacation, everything is long term. So if everything is long term, don't you think ideally my equity allocation also should be on the higher side? So I've discussed long term so many times. I've told you guys so many times that if you invest for the long term, of course, for long term financial goals, equity is a good way to go, because in the long term, what would happen is your risk reduces, and at the same time, your returns would outperform. You will get better returns and beat inflation pretty well. So what we are going to do is we are going to shift 4 lakhs from insurance to equity, which means I'm going to make this 2 lakhs, and I'm going to make equity as 12 lakhs. So your total net worth still remains the same, but it's just that instead of insurance, I've taken it to equity. So now let's see the difference. So now what is going to happen? Your retirement corpus has become 6.35 crores from 5.12 crores. And now your retirement, or now your corpus becomes negative after 21 years. So till 21 years after your retirement, which means till 77 years of age, you'll be able to manage if you were to make this small change. Okay. So I'm going to put that. So which is this is 6.35 crores and 21 years. So that's 6.35 crores and 21 years. And this is scenario 3, where I have increased equity allocation from insurance. Clear? This was a third scenario. Now, what's the next scenario? So in our post-retirement return, a lot of us tend to be conservative, and we take a number which is generally on the lower side. I'm going to show you that if we take slight risk in terms of retirement, right? So a lot of times what we do is we put our retirement corpus only in conventional products, and that's why I've assumed the return to be about 7.5%. But if I say that, let me increase that return to 9%. Instead of 7.5%, let me make it 9%, which means I'm taking slightly more risk. So maybe I'm investing in, say, hybrid funds and so on, right? So I'm investing in a portfolio of hybrid funds, debt funds in my post-retirement. Then let's see what will happen, right? So here in my post-retirement return, instead of 7.5%, let me take 9%. At the moment I take 9%, my portfolio becomes 6.35 crores, and now it becomes negative after 26 years. So in the previous scenario, it was becoming negative after 21 years. Now it is becoming negative after 26 years, right? So 26, and here it is 6.35 crores. And sorry, just a minute. Yeah. So obviously, this is not going to change at all because it's only post-retirement return. It is only going to change after retirement, which is 26 years ke baad it is changing. So here it becomes 26 years. My portfolio, nothing will change because I have not made any changes to my portfolio. Only post-retirement, I have made changes to the returns. This is scenario 4, post-retirement return of 9% instead of 7.5%. Clear? Now what I'm going to do is I'm again going to, in the last scenario, I'm again going to shift little more to equity, say from fixed deposits. Okay, so I'll just shift, say, 2 lakhs from fixed deposits. So 2 lakhs from fixed deposits to equity. So if I increase that as well, look at what is going to happen. So now my portfolio becomes 6.85 crores, and now it is becoming negative, or it is not becoming negative. Now for the whole of 30 years, I will be able to manage my this thing because now my portfolio is not becoming negative at all. Okay. So this means, I hope you understood what I'm trying to show you. What I'm trying to tell you is, so increase scenario 5 is increase your equity from FD, right? And now it is not becoming negative at all. So as you can see, these different scenarios, right? So through these different scenarios, I'm just trying to show you something very simple. I'm trying to show you that if you were to just stick to your original plan, which is you increase your investments only by 5% every year, you start off with just 20,000 savings every month, then you are not going to be able to manage your retirement because your corpus will go negative in just 4 years. But if you make these simple changes, so increase it to 30,000, look at 10, it becomes 10 years. If you increase your saving percentage from 5% to 7.5%, your retirement corpus stays positive for 16 years after retirement. Increase your equity allocation. If you increase your equity allocation, then look at the kind of changes. Post-retirement return, make it 9% instead of 7.5%. So which means be a little more aggressive in terms of managing your or putting your money in the post-retirement investment, right? Instead of putting everything in fixed deposit, take little risk, put in hybrid funds, put in debt funds. Look at the kind of change that it can make. So what I'm trying to show you is that when you're looking at your financial goals, guys, it is very important that we make those simple changes. We learn to do these small things that, you have to increase your saving a percentage. You have to start investing a bigger amount, cut down on your expenses if required. Okay. And at the same time, when it comes to investing money, look at slightly aggressive approach in the sense that, put a little bit more in equity instead of, putting a bigger chunk in conservative investments like fixed deposits. At the same time, post retirement, put in slightly more risky products like hybrid or debt funds. Okay. And when you do all these things, you will see that you will actually be able to create that corpus for yourself, which is going to help you live manage your retirement corpus for a much longer time. Now, if you're doing all of this and you're still not able to manage your retirement corpus, it is still coming negative, then what are some of the things that you could do? Then one thing that you could definitely do is for your higher education, for your child's higher education, you can take a loan. Okay. Because a lot of times, so you could just take a loan in your child's name, who can finish his or her higher education and start paying up that loan. You don't have to pay the whole amount. You could just start with, say, maybe, or just take 50%, you pay from your pocket, take 50% loan. That is acceptable. Education loan is a good loan to have, like we were discussing. The next thing that you could do is maybe delay the whole process of buying the house. Instead of buying in 8 years, maybe look at buying the house in maybe 10 or 12 years. So when you delay that process, because you've built a bigger corpus for yourself, automatically it'll impact the whole investment scenario, your whole journey. And increase your saving percentage from 7.5% to 10%. So we took 5% in the original scenario, then we made it 7.5%. I'm saying make it 10. It's going to have a huge impact on your portfolio, right? So which is why these are certain learnings that I want you to take from this particular session. That we've discussed these learnings in our previous sessions, I want you to, I hope you've been able to see it in the Excel for yourself, that how these small changes can have that impact on your portfolio. Okay. And I do believe that a lot of people say that, let me start investing from tomorrow, let me have fun today. Well, the savings requires time. You have to give your investments enough time, so you have to make sure that you're giving enough time to your investments, so that you're able to manage your portfolio effectively. It's the small things that really have a big impact on your portfolio. Okay. And instead of being short term, instead of having a very short term view, don't be greedy in the short term. Look at these simple things that you can make. Look at good quality equity instruments which can give you those 12-13% kind of returns. So those equity instruments could be stocks, could be mutual funds, which are giving you those 12-13% kind of returns, are what you should be going for, not for equity trading where the risk is super high. Because to achieve our goals, we don't really need to take too much risk. We don't have to complicate our life. We can just keep it simple, and just design that portfolio. Because what's the eventual purpose of saving? The eventual purpose of saving is wealth creation to achieve financial goals. And if you're not able to achieve financial goals, if you're taking so much risk, then what's the point, right? So that is why stick to your basics that we have discussed, and you will be able to get to your financial goals well. So that's why I say it's important to have a plan. It's important to look at your whole journey holistically, so that you're able to understand if you're doing it right now. And that is why I request all of you to do this particular calculation for yourself, to be able to see if you're doing the right thing. Yes. So great. So yeah. So with that, I would like to end my session, and I'm going to take some questions. I do hope you guys understood what I was trying to explain to you. These are certain things that I learned when I was in my 20s, and I've been applying all these concepts in my investment journey, and I know the kind of difference that these small things have made to my investments. Right. So which is why I do think that you should also apply this. I've also showed you all the formula, how it is done. I've shown you basic, just how to plug in the formula to create this sheet for yourself. So yeah, so please go ahead and do this calculation. Okay. So now I'm going to quickly take some questions. Okay, so you guys want the Excel. Let me talk to the Groww team and figure out if we could share the Excel with all of you. And if you're not able to share the Excel, just watch my video. I've showed you how to do the formula. You can just plug in the formulas yourself. It is really easy. It is not very difficult. It's a very simple simulation that I showed you. So you can just do it for yourself if we are not able to share the Excel with all of you. But we are going to try. We're just going to figure out in the back end how to do that. Okay. Okay. Any questions? Okay. So I have a lot of comments. Thank you for all the nice comments that you guys have given. Okay. Okay. Without thinking about risk and increasing equity is half the story. Okay. Okay. What are some of the questions, guys? Do you have any questions? Okay, so does the rule work if you retire at 40, assuming we live till 90? So yeah, so you'll have to do this calculation, Arka, and see if this works for you, right? So this is the calculation is required. That is important. So how to plan for emergency funds? So Neeraj, you saw in my asset allocation, in the assets that we had put fixed deposits and so on. Now those are your emergency funds. So why you put in a fixed deposit is your emergency fund, which could be used in case of contingencies. So since we don't know when a contingency is going to come, we cannot plug it into the portfolio. But then your fixed income products are your emergency funds. Okay. 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 How are the annual expenses so huge after retirement? So Dilpreet, the annual expenses are so huge because of inflation, right? I mean, we are talking about today, if my annual expenses are say 2.5, 3 lakhs approximately annually, if my expenses are, say about 24 lakhs, right? So what I'm trying to say is that after retirement, think about it. If you're going to retire after 25 years and we have taken inflation into account, so based on inflation, your annual expenses are going to be so much. And that's a fact of life. You have to take inflation into account while you are doing your calculations. Yeah. So your expenses are going to be huge. And in my calculation, I've only taken 80%. I've not even taken 100%. I'm saying your current expenses, when you take it to the futuristic value, and only take 80% of that, because post-retirement, we're just assuming that, your current expenses are not required. 80% of that should be enough. Okay. Okay, what are the questions? Yes, of course. I mean, taxation is always going to be there, right? Of course. So what are the taxes on equity that you're going to pay? If we pay 10% in long-term capital gains over and above 1 lakh, and of course, you have to pay the taxes. but to a large extent, you will be sorted if you are following the strategies that I have discussed with all of you. Milind is asking what about medical expenses. So, guys, for medical expenses, you take a health insurance, right? And that is how you're going to manage your medical expenses. If we start saving for our medical expenses, then we'll not be able to manage, our other financial goals. So, for your medical expenses, you look at taking a good health insurance for yourself, which should be able to take care of all the health expenses of yourself and your family. Okay. Okay. Some of you are not convinced. That's fine. I do believe that you should just do this calculation, and if you're still not convinced, then we'll have a conversation. Okay. Any other questions? Okay, so I don't see too many questions as such. Okay. Thank you, Narsimhan sir. You're always kind with your words. Thank you so much. Okay, so I guess since there are okay, so what are the best avenues of investments? KP Singh ji, for your avenues for investment, we've put the whole assets in place, right? So for equities, you look at for a relatively safer side, look at mutual funds. If you think you can manage your if you think you can identify good stocks for yourself, then go ahead and invest in good quality equity instruments, so good quality stocks. Okay, and of course then do an asset allocation. So I would request you to watch my previous videos on asset allocation, on all the other topics. You'll be able to get a view in terms of where to invest your money. Okay, today's presentation logic was to tell you that everything that we have discussed, is it working? Have I, it's basically like a thing to tell you that if you apply the simple logic that I have discussed, but I've not shown you in an Excel, but today I try to show it to you so that you get a holistic view in terms of how it's going to work for you. Okay, so which is the best mutual funds today? I cannot advise any names. I cannot tell you which is the best mutual fund. Not allowed to do that. But you have a lot of good options. I would say if you are going to take a little lesser risk, then you could look at large cap funds, mid cap funds, flexi cap funds. They're the good category of funds to have in your portfolio. Okay. NPS, yes, NPS is a good option in terms of saving tax. The only challenge that I feel with NPS is liquidity, because NPS pretty much has a lock-in. At least a big chunk of the investments are locked in till your retirement. But yes, it is a good investment from a tax deduction point of view, because you get an additional 50,000 tax exemption over and above your ATC 1.5 lakhs. Okay. How about ELSS fund? So yes, equity linked savings scheme. These are your tax saving funds. Of course, you're going to do your 1.5 lakh rupee investment every year for tax saving purpose under ATC, and ELSS is it's exempted under Section ATC, so you can very much invest in ELSS, and that will be a part of the equity section that we discuss. So all your equity investments, be it ELSS funds, any other category of funds, stocks, all that will form the equity section in the Excel sheet that I have showed you. Okay. EPF versus mutual funds, there's no comparison, right? Provident funds and mutual funds are two different products. Provident fund is a fixed income product, and mutual funds are, depending on which category of mutual funds are you talking about. Are you talking about debt? Are you talking about equity? So yeah, I mean, I would say there's no comparison. Of course, EPFs you keep for the short term, and at the same time, your mutual funds, equity mutual funds, are for the long term. So yes, so I guess with that we can end the session. Thank you so much, everyone, and I hope you had a good learning experience. Feel free to put in your feedback, and I'll be more than happy to improvise. So thank you so much, and have a great weekend. I'm going to do the same session in Hindi after half an hour. So if any of you are interested to listen to that, do join in. Thank you. Bye bye.